Hello, everyone. Uh, Welcome to this session. Today, I and Anuj are going to discuss about markets. It has been a very volatile markets, and on a lighter note, we wanted to start this. And as you're seeing, a lot of us are very anxious, very angry on why are markets hurting us now, right? There are a lot of questions in a lot of our minds. A lot of people are anxious. What is the portfolio gonna do here on? Uh, Whether I should exit, whether I should further invest, what is the strategy ahead? So a lot of people are very anxious and very angry also, looking at the markets. uh, uh, right now we are going to talk about everything. We are going to address each and every question of yours in this session. So how we are going to do this session is that we are going to discuss about the macros and what we are seeing in terms of Indian markets right now. Then we are going to talk about what we are seeing in terms of our fundamentals, our portfolio, and how we are going to position our portfolios going forward. And then we are going to end this session concluding what lies ahead. Right. So let us start with understanding the market cycles first. Right. I'm going to quickly take you through these things so that we do a quick recap of what we think, and we tell you about the macros, and then we go to the fundamentals, right? So understanding the market cycles, if you understand the traditional textbooks, the market cycles look pretty predictable, right? There is initial stage one where there's accumulation, then there's stage two where there's uptrend in the market, then there's stage three, which is distribution of stocks to the market, to the retail investors in particular. Then there is stage four, which is the downward trend in the market. If you look at certain scenarios in the past, and we have seen a lot of such scenarios, like we have seen a full-fledged war in our lifetime across the globe. We have seen markets witnessing a COVID-like scenario in the past. So, and now we are seeing a trade war kind of a scenario in our lifetime, right? So, if you see these instances, we have talked about it in the past also. हमने इसके बारे में पीछे पहले भी बात करी है कि जब whenever we see something new in the market, like we are seeing trade war in first time in like so many decades that in our lifetime we have not seen any trade war. We are seeing it for the first time. The markets tend to get nervous. What is going to happen? And especially when the US is pressing the trigger button, it becomes further uncertain, and the markets get nervous, right? So if like so say when the COVID like scenario happened for the first time, we had not seen that kind of a scenario, and the markets got nervous, like what will happen, whether the world is going to end, whether things are going to revive or not. And we saw a lot of assets. We saw real estate falling a lot. We saw markets falling a lot. And that then when the things start recovering, that came up pretty well, right? Likewise, when trade war is happening and the markets are witnessing this for the first time, we are seeing a disruption happening in the market. And the market has not witnessed this kind of a thing in the past. And when this kind of a thing is happening, everyone tends to get nervous whether India will be able to manufacture for US, whether India will be able to export to the US, whether India will have good trade relations with countries where Europe is there, like where US is also pressing on Europe to further put tariffs on India. So a lot of uncertainties prevail, and that's what we are seeing right now, right? We have seen from April, since Trump came into power, we saw a lot of disruption and coming into play, right? But the key insight here is the disruption creates hidden opportunities for smart money, which moves into undervalued assets. So times like these teach us again and again that you have to keep disciplined and you have to stay invested rather than trying to time the market, or rather than trying to time any news in the market, right? Like that, like Trump will do a trade war, or Trump will settle the trade war, or we will do. So rather than trying to time these instances, we should rather stay disciplined and stay invested in the markets in these times. So The reality of the timing, market timing. So in hindsight, markets look pretty predictable, right? Like हमें लगता है कि market तो बड़ा predictable है, positions real time में ऐसी identify करना इतना आसान नहीं है, right? If you are sitting at a particular situation and event that it cannot be predicted, like trade war, that could not have been predicted by anyone, and these type of events in hindsight तो हमें लगता है कि ये तो इतना वर्ष हो जाता trade war. But if you look at sitting in April, you could not have predicted that the trade war could go that aggressive or that bad, right? Or even a war between India and Pakistan, you could not have predicted that this could go that to that extent, right? So a lot of these uncertainties cannot be predicted, and as an investor, as a disciplined investor, a lot of times you get caught on the wrong foot trying to time these instances, right? So you have to focus on fundamentals, and professional investors like us embrace uncertainty. So you have to understand that uncertainties will be there in the market. That's the beauty of the market, that you will have uncertainties at all time. And even it is not a flat curve, right? Like it is not a FD. It is a there are uncertainties in the market, and there are good rewards for patience, good rewards for discipline, and good rewards for keeping a track on fundamentals on an ongoing basis. So markets keep on reminding us these kind of things. uh, if you look at the markets, what has happened over the last few years, right? So we have seen a pretty big account surge. बहुत सारे investors आए market में. हम लोग शायद 2-3 करोड़ डीमैट अकाउंट्स पे थे, समवेयर अराउंड 14-15 में. एंड till now we have crossed more than 18 crore demat accounts. So there has been a significant surge in the markets. A lot of new demat accounts have opened. A lot of new retail investors have come, participated in the market. But now is the time of reality check, right? When you see volatilities, that's the testament of yours. As said by Warren Buffett also, when the tide turns, you get to know who's swimming naked, right? So a lot of retail investors जिन्होंने कभी देखा नहीं था इस टाइप का डाउन टर्न और इस टाइप की अनसर्टेनिटी, दे टेंड टू गेट नर्वस, right? And that's what we have seen, right? A lot of these investors, retail investors, sold in panic. A lot of them were anxious. A lot of them were nervous. What is going to happen? And we have seen, particularly the small and mid cap market, seeing some panic selling coming, particularly from these retail investors. At that has ensured that even in the मतलब बिना वॉल्यूम के, बहुत ज्यादा वॉल्यूम नहीं हुआ, फिर भी मार्केट प्राइसेस गिरे हैं. बट इन हाइंडसाइट इफ यू लुक एट, वी सी दैट इसमें तो हमारे जो वैल्यूएशंस है बहुत मतलब इतने नीचे वैल्यूएशन पे भी सेलिंग आ रही है. या बट इफ यू लुक एट दिस, इट हैज बीन मोर बिकॉज ऑफ द वॉल्यूम हैज नॉट बीन देयर. इट हैज बीन मोर बिकॉज ऑफ द retail getting nervous and anxious and selling these small and mid caps at even at lower valuations. So that has been a very key reason for doing for this kind of a fall that we have seen, particularly over the last few months, right? So if you look at the macros also, I'm going to talk a lot about the macros and micros after these slides. But if you look at the macros also, the Trump's mood has changed a lot, right? We earlier, when Trump was coming into power, when Trump won the elections, we were very positive that when Trump won happened, they did a trade war with, although they did a trade war with China, but that would have India and US had shared a very good relation, and we thought that this would percolate into India gaining significantly in terms of trade. But when he started off, it got pretty nasty, and he had a lot of pressure also. We're going to talk about what pressures he has, but uh, he has changed his stance pretty often, right? Like sometimes he says that India is a very good friend, then he says that India, I'm going to put India 50% tariffs, India is a dead economy. Then he says that India Modi is a very good friend. India is a very good friend. He keeps on changing his thoughts, right? He keeps on changing his statements very often. So there has been a lot of policy volatility, right? And there is a lot of realignment and efforts to realign happening. India and China were not naturally realigning, right? But because of these instances, India and China are trying to realign their trades and their conduct, right? So there is a lot of border conflict also that is happening. So macros had turned volatile over the last few months, which has created a lot of impact in the markets, right? Likewise, if you look at micros, there has been some significant positives in the micros. You look at GST rationalization has happened, capex, the capex. If you look at over the last few quarters, there have been significant capex that has happened. The monsoons has been above normal. There is a festive that we are looking at going forward, which is going to create a positive, right? So like let's go to the current situation, what is happening, right? If you look at the current situation, the crude oil is at $66, which is pretty low, right? At this point in time, in all standards are even at $66 Brent crude, we are buying oil even cheaper rates from countries like Russia, which is significantly reduced our fiscal current account deficit, right? Our fiscal deficit is pretty comfortable. Our current account deficit is at lows, right, which is pretty comfortable. You look at dollar index, it is 97, which is pretty comfortable. You look at 10-year bond yields, India 4.0, India 6.49, US 4.07, which is pretty comfortable. If you look at volatility index, that is comfortable at 10, right? Inflation in August came at 2%, which is at 6 years low. So a lot of factors are looking, this is the current situation, and a lot of factors are looking positive. If you look at July, August, there has been exits seen from FIIs because there had been a lot of policy uncertainty, which we talked about, right? And like 70,000 crores FII money went off from Indian markets, but the DII participation kept on happening, right? Even in 2025, 1.3 lakh crore FII exit happened. DII's participation has increased to at all time high at 18%, right? Even if you look at mutual fund flow, every month more than 28,000 crores is coming to mutual funds in terms of SIPs. So the domestic participation is intact, and people are sensing that, hey, we need to be disciplined, and that's what we are seeing at this point in time. A lot of participation from domestic institutions. If you look at the debt to GDP, now this has become a big problem at current scenario. The debt to GDP of Japan is at 250%, of US is more than 130%. Historically, at these levels are unsustainable, and that creates a lot of pressure on the economies, and they tend to face slowdowns and recession after this kind of a debt to GDP. So the US is also attempting to solve a lot of these problems, right? They're trying to solve the debt to GDP by either inflating the assets through their efforts, by either getting money from people in terms of issuing golden visa, by in terms of like getting money in terms of trade wars, and getting money invested from some of their large companies into their countries. So they are trying their best to ensure that the country doesn't falter in this kind of a scenario. But usually the debt to GDP is a very big problem globally, and India at 80% is pretty comfortable. If you look at right. We've seen a lot of countries like France, the government fell off. Japan, we have seen government issues. Nepal, we have seen government issues. All those are a lot because of the debt that the government has, and they had to cut spendings of their common people, and the common people starts creating a ruckus, right? So but if you look at India, we are in a pretty comfortable kind of a situation, having only 80% kind of a debt to GDP, and that too improving on the positive side, right? But if you look at the net NPAs, they are pretty comfortable. Uh, every global market, if you look at, has certain one or the other problem, right? Certain economies of the world have very high debt. certain economies have consumption issues. They have very aging population, do not have that kind of consumption like China. You have certain economies where the population is pretty aging. You see Greece, you see a lot of these European nations, you see Japan. The population is aging, and there are no efficient labor that is there. There are certain countries which do not have manufacturing. Like if you look at Sri Lanka, you look at Nepal, a lot of these countries do not have manufacturing for themselves. And times like these, manufacturing is very much required, right? So if you look at India, we are pretty much isolated from a lot of these issues where we have our own manufacturing, our debt is low, our consumption is there intact, our age is comfortable, the median age is 29. So we are seeing a very pretty decent kind of a comfort in these terms. What are the positive drivers going forward, right? So we have seen GST rate cuts. We are going to see Diwali spending ahead. The worst of US trade is already factored in, right? We have already factored in the worst of US trade at this point in time. The valuations in many pockets are looking pretty comfortable. If you look at the domestic money, that has been pretty intact. The capex has happened, which is going to show positive results for the economy. Deglobalization is happening. De-dollarization is happening, which is in a way positive going forward for our kind of economies. We are seeing FTAs, we are seeing domestic consumption drivers. The rate cut is possible in US, which is further going to push the stock markets. The quarterly results that are projected. So yes, Q4 and Q1 has been nervous because of a lot of these disruptions, but Q3 and Q4 looks pretty positive. Anuj is going to talk about them in the coming slides. We are seeing a lot of government reforms and policy support that is coming in our economy. We are seeing GDP growth projections pretty consistent and pretty high, right? In a time when a lot of global economies are sensing recession, we are seeing a pretty good GDP growth projection for India, which is going to attract a lot of foreign capital going forward for sure. The domestic macros are supportive. Although FII selling has happened, we believe that FII is going to come back pretty soon as the rates fall, as the Indian macros continue to be supportive. The debt on the balance sheet of a lot of these companies are pretty low, right? The appetite, as we are seeing from investors also, as we are talking to investors, the appetite on listed pre-IPO, IPOs are pretty much intact and there, right? Like, so next few years, what is going to happen, right? So we are sensing that. There will be de-dollarization that is going to happen, which the US is trying to avoid, but we are trying to do our own BRICS currency. We are trying to bring like do trade in Indian currency. Every country is trying to bring stable coins. So the de-dollarization, as you would have also have observed, we are putting a lot of our reserves in our own in terms of our gold, and we are pulling off from dollar bonds, etc. So obviously, this is creating impact on US as it was printing the dollars to its liking without having backing of assets, and now countries are inward looking than investing in US, right? So if you look at going forward, we are sensing that considering that there are a lot of issues with Indian migrants to other countries, there's a lot of reverse migration that is going to happen, and that is going to bring in a lot of demand and money supply into India, right? Which will be a positive for a lot of businesses into India. We are seeing that the domestic companies are going to see a thrust in terms of the free trade agreements. Now we are going from a globalized world to a free trade agreement world, and India shares comparatively very positive relations with the rest of the world. We have seen a FTA with UK. We are seeing FTA going to get signed with EU. We are in US with the US also. The FTA talks are pretty much on looks on track as of now. We have signed FTAs with UAE, Australia. So lot of positive relation we have with large buyers in the world, and we are trying to find newer markets for exports. So our domestic consumption is impact. We have manufacturing. Our export opportunities are there with the FTAs. So we are going to differentiate with the rest of the world going forward. The interest rates falling in India also are supportive. So overall, if you look at things look pretty positive in those terms, right? Like if you look at Uh, so, what additional I wanted to talk about was that there has been war that has created a lot of uncertainty and anxiety amongst a lot of retail investors. We wanted to talk about it. India Pakistan war happened, Israel Hamas happened, Russia Ukraine's happening. Uh, there has been some uncertainty about high debt to GDP in a lot of countries. So, what is happening is assets are getting revalued. Money printing will happen, which will increase a lot of supply into the markets, and that will flow into the assets, particularly equity, real estate, and gold. Right. So asset revaluation will continue to happen, is what we believe. Inward looking. Countries are becoming now more inward looking than outward looking, right? There are fears of defaults, job loss, slowdown, right? But there is a realignment that is happening, and we are fairly positive with what kind of macros and micros we have. We should do pretty well, right? The manufacturing assets are the thing to go. We believe that manufacturing assets are going to get revalued because countries who have manufacturing assets, countries which have commodities, they will be valued very well. So we, as a portfolio manager, we are also placing ourselves in a lot of manufacturing assets, and they are going to continue the supplying to the domestic consumption and continue supplying to the free trade agreement countries going forward. And these assets are fairly difficult to replicate, right? You take 3 years, 5 years to create these kind of assets, and India already has a lot of these assets thanks to a lot of efforts that has gone into PLI schemes, into creating the infrastructure over the last few years. And everybody wants to diversify from China, right? So that even despite these uncertainties that are there, we sense for market participants, for investors, and a lot of these assets, a lot of these manufacturing assets in small and mid cap, right? So we've sensed that there is a lot of opportunity in terms of these small and mid caps going forward. Right. So what I would want to conclude is saying that there are periods of volatility. But these periods of volatility rewards those who stay invested with a long-term perspective rather than attempting to try time the entries and exits. So you should stay invested with a long-term perspective. There are these type of times that comes in. A lot of us panic, go away from the market, exit. But then these weak hands exit, particularly retail, like what is happening currently. But then small and mid caps usually do a strong rebound after these sharp declines, and we are going to see that kind of a period going forward. And that's where we want to give you that kind of a input that hey, everything. Although everything is not that great, but a lot of factors, especially India factors, be it micros, macros, they are pretty much comfortable. Anuj is going to talk about the fundamentals also, but a lot of things are pretty much comfortable, and we are going to see a very sharp rebound in small and mid caps and the kind of stocks and fundamentally strong stocks that we participate in. So you have to hold your horses and you have to stay invested in these times. Over to Anuj.
Hi everyone. So I will start with a very popular quote of Charlie Munger that goes by the big money is not in buying and selling, the big money is in patience. So this is a very well-known quote. Everybody knows about this, and there are other quotes as well of Warren Buffett and Charlie Munger. Everybody knows these quotes. Everybody understands them. Yet we fail to follow them, yet we fail to adhere to them. That is the biggest mistake everyone does. The investment is very simple. All the age old principles like buy when everyone is selling, sell when everyone is buying. I think it's by Warren Buffett. Do not buy a stock if you don't want to keep it for next 10 years. So these are the basic fundamental principles of investing that has been established 50, 60, 70 years back, and that has not changed, and they are not going to change forever. Okay, the momentum behind a sector might change, the momentum behind a stock might change, the fundamental of an economy might change, but these principles are not going to change. We everybody knows these principles, but nobody want to follow them because of the sentiment and biases. So basically, we get a lot of question as to, I mean, whether it's a good time to be invested, whether I want to take an exit. Now, look at the statement of Warren Buffett. When everybody is selling, you need to buy. Okay, and you need to sell when everybody is buying. So when there is a euphoria and FOMO in the market, that is the time when you want to keep cash. Not at this time. This is not the time you want to sit on cash, because this might be the worst possible time, or this might be bottom or close to bottom. So this would be a very uh, bad timing to take an exit or to sit on the cash. So this I will start with the fundamentals and our portfolio. Because a lot of audience will be should be our clientele who takes services from Green Portfolio. So basically, let me go through the portfolio that we have built and how it is placed in the current circumstances, current situation. So the portfolio is, yes, we focus on manufacturing, and we like companies where they have product approval from Europe, US, because these are the two giant market in the world. So if you have a product approval there, if you have a relationship already there, so it is very easy for you to scale, particularly in the situation where everybody want to diversify partly away from China. So that poses a very big opportunity. So since beginning, we are focused on tapping that opportunity. So we are manufacturing focused. And in the manufacturing, we are focused on those companies that have a established relationship in the export market, like US and Europe. So some of the companies have been mentioned. Some we have withheld the names for obvious reasons in most of the cases. But if you see the chart, then you will see that there is not much exposure to the export market. So basically, barring one or two companies that has more than 50% export share in the US market, rest are placed very, in a very good position. And particularly, if India signs an FTA with EU, then they are in a very good position. So they can see a massive rally in case India and EU FTA sees the day of the light in this calendar year, which has been promised by Mr. Piyush Goyal, that the talks are in the right direction. So basically, they are in a position to tap that market in a very meaningful way. Just to add a context to that, I was having a discussion few months back with a home textile company promoter, and I got to know that EU charges approximately 19% duty in the home textile that India export to the EU, and at the same time, Bangladesh doesn't pay any duty. So we had a 19% disadvantage at that point of time in comparison to Bangladesh. So this 19% is too much. I mean, you compete on 5 to 6% kind of a price difference in the global market. So 19%, if that goes away, then that gives you a huge edge over China and Bangladesh, or make it comparable with China and Bangladesh. So basically, the point I'm trying to say is whatever negative sentiment is there because of the US duty actions, that might go away after a FTA with EU is signed or is close to sign. So the sentiment reversal can be there. So this might be a very bad timing to take an exit or sit on the cash. Number one. So number two, our portfolio, is less than 25% export focused, and export means throughout all the geography, not only US. So we are very well placed as far as deglobalization is concerned, or as far as duty action from the US is concerned. In most of the companies, we have visited the plant, we have seen the facility, we have connect, we do management interaction, we are connected to the management. So we understand the business, we understand the product, we have an idea as to where the industry is heading, how the product is doing, and all those things. So basically, we know where we have put our money. We are on top of it, despite the fact that last 9 months has not been too good for Green Portfolio. But we are fairly confident that the future, whenever the sentiment reversal will happen, we will be leading that rally from the very top. So this is the conviction based on the insight we have developed on the management, on the product, and on the company that we are invested in. So these are some of the examples we have where we have created multi-bagger spectacular returns, despite the fact that at that point of time the market was very apprehensive about these stories. Titagarh wagon we started buying at 40, 45 levels. Currently it is trading at 900. It reached to a top of 1900. So we have taken an exit somewhere around 500. That means made a 10x kind of a return since our first entry into Titagarh. But right now it is also in the buy list because of the latest actions and developments around the company. Time Technoplast is a share that we still hold. It's already 8 or 9x for us. HFCL is a very promising multi-bagger story that we are investing in. It is yet to perform, but we are very confident that it will perform because the thesis is going in the same direction. So when we started investing in HFCL, it was talking about some defense products, some product that was approved, but they did not have any order book at that point of time. But now the thesis has got stronger after 9 months or a year now, because they have started receiving orders in the defense vertical. A latest development says that 1,000 acre of land has been allotted to them only for the defense vertical. So I am pretty sure this share will be a multi-bagger for us very soon. Synergy Green is again a multi-bagger story for us. While everybody was talking about solar, we see a potential in the wind energy as well. They were getting orders from left, right, center around the world for casting and forging product relating to the wind energy sector. So just to add as to how patients can pay and how the investor uh, should maintain his mindset during the time when the share is not performing or the market is going through a turbulent time. Take the example, we were buying Force Motor since we got the PMS license in 2018. July 18, we started operation, and Force Motor was in the first portfolio, first client that was onboarded in the PMS with us. We were buying Force Motor in 2018, we were buying in 19, we were buying in 20, then COVID crash came, we were again buying. So we started buying from a level of 1400, we bought till 1900, then it went down after COVID, we bought till 700. So our buying range is 700 to 1800, and average would be around 1000 or 1100 types. And we have taken an exit at like 9000, 8000, 9000, even though the share has given a solid run up after that as well. So, but again, I cannot ask for all the profit of the world. So I made like we made like a 8x kind of a return, 7 8 kind of a x kind of a return in the Force Motor. But that is not the point. The point is, why did not we sell Force Motor when it was not performing in 2018, in 2019, in 2020, and in 2021 as well. Okay, so the reason was we entered in Force Motor with a thesis. There was some estimations around Force Motor that it will do this, it will do that, and when it will achieve this, then the numbers will be like this, and the share price should reflect like this. So some things got delayed. For example, JV of Force Motor, the operationalization of that got delayed due to COVID, but it was in control. Rest all the story, except for the impact of COVID, was going in the same direction. So if everything is going as per your estimation, your premises, your thesis, then there is no point to change. I mean, if you believe in yourself, then you believe in your thesis. So see, till the time the thesis and the fundamental remain the same, there is no need of taking an exit. Rather, take it as an opportunity that you were liking this share at 1500 price, then why you should not buy it at 1000 price? So basically, the question that one should be asking is whether there is any fundamental concern behind the share price going from 1500 to 1000. If there is no fundamental concern, then it's an opportunity because we were liking the share at 1500 level. So we were following, we had faith in our thesis, and the thesis was going in the absolutely right direction. Because we keep every share that we invested into track. So we kept on accumulating the share, and it paid off at last. And similar example is Balaji Amine, where again we made multi-bagger 7 8x kind of a return, and we only relied on our thesis, and we were tracking that if everything is going as per the thesis or not. And since it was going in that direction, then we were accumulating at every fall. So these are two examples in our 7 8 years of history where the patience has paid really well. I mean, there are more examples, but then the conversation will be very long. So basically, that the example of Force Motor and Balaji Mines doesn't mean that we have not learned new things in this 7.5 years of journey. We have made mistakes as well. We have taken corrective actions as well. For example, during this recent fall, we realized that we need to take an exit from 6 or 7% kind of allocation in the portfolio that was there in the 3 or 4 scripts. We have taken that exit. We have booked losses. Some one or two share might still be there in the holding in some quantity. We are in the process of taking exit. And we later on realized that we need to maintain the concentration as well. So we will be working toward a more concentrated portfolio going forward. But the concentration will be so much that it is diversified as well. So wherever we have felt the need to take an exit, the thesis is not going in the same direction, or maybe there is higher conviction in certain pocket or in certain scripts, we are switching those share to high conviction shares. And then we are the team size is increasing, so we are focusing more on interactions with the company or the people in the trade or peers in the trade. For example, research analyst of other fund houses. We are accumulating those collective knowledges to get to a conclusion. So this is how we are placing ourselves for the next rally to come. And I think most of the action has already been taken. So that is why I believe that the next rally belongs to green portfolio. And for those investors who are not a part of green portfolio yet, I would say that it is all about patience. Have faith in your selection. Give it some time, because you are not God that whenever you will enter in a share, it will start running from that point only. So everything takes time. Certain story will take time to get noticed by the market or bigger fund houses. So basically, have patience. Next 10 years belongs to India, and we are biased toward Indian manufacturing because we believe that Indian manufacturing will do much better than other sector for next 10 years. So basically, this is my message to everyone. Over to Divam.
Yeah, thank you so much, Anuj. So, this is what we wanted to talk about, right? So, we have seen very good times. If you look at our performance, there have been some very good times. There have been some times where the markets have tested your patience. So, these have been some times where the markets have actually tested our patience. But if you look at the fundamentals, they are pretty much intact. If you look at the macros, are pretty much intact, and we are very positive how we are placed in terms of our allocation, be it in terms of manufacturing, covering a diverse space of manufacturing, as well as like covering infrastructure. And obviously it will continue to be discipline and patience, and that's what rewards long-term investors, right? We have seen that a lot of investment styles have faced challenges in these times. We've seen momentum facing challenges, and but long-term wealth has been delivered by value investing, and that's where we continue to focus on. Additionally, this period will continue to be stock pickers market, and we are fairly confident with our selection. Happy to talk with investors individually as well on our theses of our portfolio. In the near future, we are going to release a product note and a fund manager's note as well, where we are going to cover all the stocks and our theses on those stocks, why we have picked those stocks for our investors, uh, and reassuring that you are facing a lot of anxiety, a lot of anger or uncertainty about the markets, what has happened over the last few months. But yes, we are on the rare end, and almost all the negatives are factored in, uh, and the forward looking is pretty good, and the companies are also pretty good. So we are going to make money for sure, but it's going to test patience for sure. So with this, we would like to end this saying that the stock market is a device for transferring money from the impatient to the patient. And that's what is happening right now as well. A lot of retail investors have panicked, sold stocks at the lower levels in panic, and a lot of patient investors who can hold these stocks for the long term have bought them at really mouth-watering valuations. And that's what is the message, and you should also try and practice this. I understand psychology, but practicing this will result in good value creation and wealth creation over the coming years. Thank you so much, everyone.